Hello, everybody. Hello. Let's go by here. Work? Yeah, hi. So I'm conscious that I'm keeping you from lunch, so we'll keep it snappy, I think. I think it's a 20-minute slot. We'll try and make it 10 minutes. What I wanted to do is to just share with you some of the experiences that we're seeing in the aviation sector in respect of how credit solutions are being used to improve funding and working capital. So I work for a company called Aon. We're a professional services company. I work in the insurance part, so insurance broking. I was glad to see all those hands go up about reading insurance contracts in the session earlier. What I'm going to do is split this into three parts. So one is, what are the products we're talking about? Two is, how are they used by lenders and how can they encourage financing? And then the third is, how are they used by corporates and how can they improve working capital for corporates? So first slide. What are credit solutions? Credit solutions are credit insurance, which covers credit risk, non-payments, political risk, which covers non-repossession of the aircraft, and you heard the good presentation earlier today about political risk in the sector. There's a couple of old cases there, Monarch and Alitalia, of insolvency cases, and I put those up because these are cases where insurers paid out on claims, on credit claims. More recent claims, like Privet Air in Switzerland, Avantia in Brazil, and Jet in India, are all keeping the credit insurance markets interested, given the values of the potential exposures that are faced in those areas. So why are lenders using credit insurance? So basically it's one of three reasons. So lenders use credit insurance to cover non-payments under the loan agreements. Why will they do that? So one is for risk management, so if perhaps they have an internal limit on a counterparty they're lending to, and they use credit insurance to support the internal limit, to cover the non-payment risk under that financing agreement. The second is concentration. So, for example, if there's a 20 million counterparty internal limit that a funder has on a customer, then credit insurance can be used to increase that counterparty limit to 30 million, 40 million, or even bigger numbers. And then the third is capital, and this is particularly for the commercial lenders, where credit insurance is used to improve the return on equity on transactions. And how is that done? The commercial lenders are using credit insurance and the insurer's rating of A or AA to improve the probability of default on deals and therefore allocate less capital to those transactions. It's a complex area, depends on the regulatory position of the bank, but it's an area. And the part on my left is an example of a transaction and where the insurer sits. So the insurer sits behind the lender, issues an insurance contract to the lender covering the non-payment under the lease agreement. So here's an example of a typical term sheet we would see issued by an insurer. This is an example of Ethiopia, where the credit insurer covered up to 8 years under the underlying term of the lease. It covered the non-payment of the amounts due, the scheduled amounts due under the lease, covered the principal plus the interest. The insurance is triggered on the non-payment under that agreement, and the insurers pay out after a waiting period of between 30 and 180 days, depending on what's agreed in the contract. In terms of pricing, it tends to be priced based on the underlying risk of the corporate, or priced on the basis of margin. So, for example, if the insurer is taking 90% of the risk, 90 of 100 of deal, then they would generally charge between 50 and 70% of the net margin on a transaction to take that 90% of the risk. So that's that's from a lender's perspective. That's why lenders are using credit insurance to support financing and to improve financing facilities. So it'd be interesting to talk to you over lunch as to how that can be applied more perhaps in the business jet, corporate jet context. So from a corporate perspective, so we work with OEMs and with airlines and other companies, and this is a whistle-stop tour of how the product helps, again in the context of liquidity, improving capital and cash flow. So the first is on the receivables side of the balance sheet. So this is money which is owed to the client. So this could be spare parts from an OEM, for example, being sold to customers. There may be multiple customers and receivables value of, say, 100 for ease of number. There might be multiple credit risks within that, multiple ratings. If we credit insure that asset pool of 100, it can become an A or AA rated pool, and therefore that can help the clients in raising funding against that receivable, because the bank will perceive the asset pool as an A or AA rated asset. So for example, with engines and leasing of engines, we tend to see the credit insurance product used to cover the non-payment under the lease, covering the net present value of the cash flows due, and covering the default risk of the lessee. And again, the insurance can be used for those three kind of reasons I highlighted before: the risk management, credit, and capital. On the payable side, so on the supply side of the balance sheet, where you have a client that is procuring fuel, for example, then credit insurance can be used to cover the default risk under a fuel supply agreement. It can be used to cover as a replacement for collateral under hedge facilities that are used by lenders on the basis that if a lender is requesting a level of collateral, then credit insurance can slot in to replace that collateral, can be a cheaper alternative and can potentially help improve the capital position on that trade. And then the final two areas I'll just highlight briefly is one where there are third-party guarantees issued to parties in transactions. These could be performance guarantees. There's a product called Surety, which is an insurance product issued, which is a replacement for bank guarantees, and it's quite a cool solution because it can. There's two reasons. One is it improves working capital because bank guarantees would generally tie up the bank facility, whereas the surety facility is outside of that, so is an unsecured facility, so it can be positive for working capital. And the second reason is, from a pricing perspective, surety can potentially be cheaper than bank-issued guarantees. So that's a pretty neat solution. It's a well-kept secret, but it's something that's definitely worth companies exploring if you're looking at an effective alternative to bank-issued guarantees. And then finally, the product can be used in investments, in acquisitions, to cover deferred consideration on deals, to cover political risk on transactions, and in weird and funky ways, depending on the underlying structure. So that was the three parts I wanted to highlight, and I've kind of run through them over 10 minutes. So one was, what are the products? Two is, what is it from a lender's perspective and how the product's used? And then three is how the product's used from a corporate perspective, and that's across credit, political risk, and surety. So thank you very much for listening. Are there any questions, or do you all want to rush off for lunch, which I'm sure might be the case? Thank you.
Thanks very much, Steve. Thank you. We have got questions, so don't go. Does anyone have an old-fashioned question? We've got two on Slido. One is insurance available for management companies for non-payment in the event of client's default? So this is when the owner would be taking out a contract, I think typically with a 3-month cancellation. Would you be prepared to insure in that? So
potentially, depending on the financial strength of the underlying counterparty, and then if there's any security in the underlying transaction, the tenor comes into play, the jurisdiction, where the parties are. So the answer is yes, depending on the details.
And these are quite complicated deals, so is there a minimum amount where it becomes cost effective to do,
Yeah, so for single transactions, I would say anything above 5 million US is then becomes interesting, but the deal sizes go up to hundreds of millions, so There's quite a range.
Great. And we've got a question about captive insurance. I'll let you off on that one, unless you want to.
Appreciate it.
Okay. And it always goes down well finishing early before lunch. So thank you very much. Thank you.
Thank you very much. Cheers. Thank you. Thank you.